Hello, greetings, and welcome to Dividend Blasters. This is our 40-second video, and the topic today, what you should know before investing in BlackRock. BlackRock is a big investment firm. They are the largest investment management firm in the world. They manage over $10 trillion in assets. So, I'm going to talk a little bit about BlackRock, talk about what they do, how they uh, fit into our financial and economic system and our political system. And I mentioned political because they do. They do fit into our political system in a sense. They are very big, they're very influential. And I'm also going to talk a little bit about where they invest. So they invest in everything. When you buy a share of BlackRock, you are buying shares of things they buy. It's like buying an ETF or a mutual fund or, uh, you know, uh, a large holding company like a Berkshire Hathaway. It's kind of the same thing, but it's a little different. Anyway, wanted to share that with you. And the reason why, there's really two reasons for this video. The first reason is I want to know where the smart money is. The smart money is BlackRock. They're big, they're very smart, they know the score. Okay. I want to know the score. I don't know as much as they do. I don't have as much information as they do. But if I can get in sync with them, I will be safe and I will make money. And that really is what we're trying to do. We're trying to maximize our wealth and build our holdings in our portfolios. So that's one thing. Um, and then also, as I have done on other videos, share with you a little bit about BlackRock. Is this a company that you would actually invest in? So we can look at their holdings, see if, yeah, I'd like to buy that. They're investing in that. They're the smart money. But also, do I want to invest actually in BlackRock? And you can. So that's the purpose, really two purposes or objectives here. And I'm going to go ahead and give you a little bit of background on BlackRock. I'm also going to jump into the metrics about BlackRock and show you how they stack up against some of their peers. So let's press on. First, I am not your financial advisor. The purpose of this video is information and financial education. It reflects my own personal opinions, my research, and my experience as an investor for more than 30 years. So, however, do your own research, do your own due diligence, and consult a financial advisor prior to making any major financial or investment decisions. And before we start, I would kindly ask you to give us a like and subscribe to our channel, Dividend Blasters, and share this video with a friend or a family member. What is BlackRock? Well, I've already told you. It is a it's the largest asset management slash investment management firm in the world. They manage more than $10 trillion in assets. They provide services to individual investors, intermediaries, institutional investors. I'm not going to read through all this. You can read it. But they talk to everybody. They work with everybody. They are big. They offer a lot of their own, ETFs. You've seen iShares. Those are theirs. They're big. They have equity and fixed income and real estate mutual funds as well. So they do a whole bunch of stuff. They're big. Can't stress that enough. They invest in small cap, mid cap, large cap stocks. They invest in dividend paying securities. Oh, now that is near and dear to my heart to read that. But I'm not surprised. They do everything. All right. So let's press on a little bit more about BlackRock. They were founded in 1988. They're based in New York. They have offices in the United States, in Boston, Greenwich, Connecticut, Princeton, New Jersey, Philadelphia, Washington, D.C., Wilmington, Delaware, and San Francisco. And then outside of the United States internationally, London, India, Hong Kong, Edinburgh, United Kingdom, Sydney, Australia, Taipei, Taiwan, Singapore, Sao Paulo, Brazil, Toronto, Canada. So they have a nice international presence. So, one of the things, and I did allude to this earlier, is how they fit in our political system. Uh, I found some interesting articles, and I'm giving you the link. You can pull the article. It's from TipRanks. Um, but the name of the article is how influential. I mean, really, they are the most influential company in finance. That's the title of the article. And I'm posing the question: how influential are they? Well, the answer is they're very influential. I mentioned that they manage over $10 trillion in assets. They invest in lots of companies, and I'm going to show you the list of the top 100 and give you access to all 5,600. You can see who they invest in and how much they invest in. So, this is a great article by TipRanks. Take a look at it. I found it very interesting. It's about a little more than a year old, but I think it's very topical. And then here's another article, and it's from Business Insider, and this is also about a year old. And it's 9 fascinating facts to know about BlackRock, the world's largest asset manager. Well, number one, and I already mentioned this, they oversee over $10 trillion, the largest money manager in the world. They have a massive technology platform at BlackRock that oversees over $21.6 trillion in assets. And these are screenshots from the article, but it's not everything. But just to give you a flavor, they do have strong ties to the government. And in particular, if you read a little deeper, they have strong ties to Democrats. Now, we love Democrats and Republicans on this channel, but I'm just sharing information. You can see that basically some of the very senior people have served in the President Barack Obama administration. One was a deputy director of the National Economic Council, and he's now the lead under President Biden. And then there's another gentleman who is now the deputy secretary of Treasury in the Biden administration. So they're very highly placed. A lot of influence there. They played a very significant role in the very beginning of the coronavirus pandemic with the Federal Reserve. Close relationship. I've read other articles that basically say that Larry Fink and BlackRock are probably the most influential investment firm or financial services firm in the country. But I've also read the same thing about JP Morgan Chase and Jamie Dimon. I don't think that's uncommon, but it's something that we should know about because you want to put your money with a manager or invest in a company that you're comfortable with, and you know that the money's going to be safe. I want to know that who's ever managing my money or investing my money knows the score and is going to be making good decisions. And that's what you should be thinking about as well. Here's another one. They tapped BlackRock during the 2008 financial crisis as well for help in selling off assets. So something to take a look at. You can read through it. The CEO Larry Fink, excuse me, he is very vocal on several public policy issues, and one in particular is climate change. So he's a very vocal proponent of climate change, and he has been, I would say, rather influential in electing board members for ExxonMobil. And if you actually, you'll see in the next couple of slides, you're going to see that um, BlackRock has probably over $15 billion in holdings in ExxonMobil and in Chevron, our two largest oil and gas companies. So, he's a believer in climate change, and he's probably looking to minimize the role that fossil fuels play in our economy. And he's probably an investor in Tesla, I would imagine. Something to think about. It's good to know these things so you know where your money's going and how it's going to be managed. Um, I mentioned climate change. Here's a rumor that came out in 2016. It was rumored that he was going to be a Secretary of Treasury in a Hillary Clinton administration if she had been elected in 2016. He dismissed it. He said he was very happy with BlackRock. So maybe it was a rumor or maybe it was just a trial balloon. Don't know. Uh, BlackRock has gotten very big over the years since 1988. They've done it brilliantly through organic growth as well as through a lot of acquisitions. And you know what? Good for them. Kudos to them. All right. So again, why am I sharing this with you and where am I going with this? I I want to know where the smart money is on Wall Street. I want to know what's the best place to put my money. I would say BlackRock is the smart money. BlackRock is the big money. You want to be with the guys who know the score. And BlackRock clearly knows the score. How do I do this? I pulled the 13F submission. 13Fs are required by law. Um, Institutional investors that manage more than $100 million must submit a 13F each quarter to the SEC. So this is what I've done. I pulled an excerpt of the 13F. I've given you the link. You can get it right from the SEC site, or you can get it from this link that I'm showing right here. You can look at all 5,500 holdings, um, and they are valued at 3.4 trillion. Now, let's just stop for a second. I said they managed over 10 trillion. This is 3.4 trillion. So, where's the rest? Okay, that's about 6.6 trillion. I'm wondering, does that mean that they are in cash? Could be. Don't know. It's not clear. But we can put two and two together. And I do know that a lot of investors are pulling back a little because they think there's going to be a market correction. And having cash gives you flexibility, gives you leverage to go ahead and have the ability to be flexible. So, anyway, I'm deducing that. I don't know that, but that's my deduction. All right, let's take a look at the top 100. That's what I'm going to show you. I'm not going to show you all 5,600. You can look them up, but you can see here I've listed the companies that they're invested in, the dollar value, the percentage of their holdings, and the number of shares in the top five. You can see our Apple, Microsoft, Amazon, Nvidia, and the next two are the two different classes of Google stock or Alphabet. So that's the top five, really five and six. And then after that, you got Tesla, the electric car company, and United Health, Meta Platforms, Warren Buffett's and Charlie Munger's Berkshire Hathaway. Then Johnson and Johnson, our dividend king. Then you get to your first fossil fuel or oil and gas company, Exxon Mobil. And then iShares. Okay, that is one of their ETFs. Visa, of course, the credit card company. JP Morgan Chase, Procter and Gamble, another one, MasterCard. Then you got Home Depot. Then you got three drug companies, Eli Lilly, Merck, and AbbVie. And then you got another oil and gas company, Chevron. Then PepsiCo, then Coke. And then our favorite, my favorite anyway, sorry, my favorite chip maker, Broadcom. That rounds out the top 25. And really you're going, it's interesting because at the very top, Apple, nobody has more than they don't have more than 5% in any of them. They're very diversified, but they got 5% of their holdings are with Apple, and then 4.6% with Microsoft, and then it severely comes down to 1.9% Amazon, and then Nvidia 1.5, and then 1.3 and 1.1 for Google, and then you start to get 1% and below. Uh, Yeah, and I'm not going to read all the rest of the next 25, but just maybe I'll point out some of the ones of interest that I have, like Pfizer and Costco. I see Texas Instruments, Abbott Labs, Bank of America. Okay. Bristol Myers Squibb, another drug company. Okay. Advanced Micro Devices. Well, this is a chip maker we've been hearing a lot lately. There are several experts that are basically saying AMD is, if NVIDIA is number one in the graphical chip market, AMD might be number two in the chip market after NVIDIA. We'll see. Then I see Amgen, the drug company, Next Era Energy, Oracle. Oh, and then they have Intel. That's interesting. Okay, let's go to the next one. And these are the last, the next 50. And I'll just name a few of them. I have UPS. It's a great company. I love UPS. Qualcomm. I don't own Qualcomm, but I will tell you this. I do think that it is a really awfully good investment. I like the price and I like the dividend. Let's see. They got the defense contractor, Raytheon, uh, Elevance, the health care company, Medtronic. I do have shares of Medtronic, the medical equipment company. I see IBM. I see Philip Morris, ConocoPhillips, the oil and gas company. I got to tell you, I really like ConocoPhillips. I actually sold it to do a few other things, but I want to give them props for their special dividends. You buy ConocoPhillips, you don't get four, you may get eight dividends a year. And there's a few oil and gas companies that do that. And I'll talk more about that another time. I've mentioned it before. They got Lowe's. Let's see, Caterpillar. Caterpillar is the heavy equipment company. Is a company I'm looking at buying. I think that the price is good and the dividend yield and growth are pretty good, and it's a solid company. I see Lockheed Martin. I have several shares. They're one of my top holdings. Let's see. I see automatic data processing. I'm on the fourth panel. So ADP, the payroll processing human resource outsourcing company. Another good one, I believe. American Express is a good investment. I see they've got the REIT, the telecom REIT, American Tower or AMT. They got BlackRock. Okay, so they got themselves they're investing in. That's interesting. The Cigna Group, they got General Electric. Okay, so those are the top 100, and of the 3.4 trillion, this accounts for more than half, about 1.8 trillion. You can go ahead and pull the 13F. You can look at all 5,600 if you like. Knock yourself out. So now we're going to get into the summary metrics, and I'll draw your attention. First major takeaway is that this is not a cheap stock. They go for over $700. They closed last Friday, June 16th. It's $702.78. So that is a lot. But look at the PE ratio. That tells me that they have decent earnings because it's 20. Okay, it's 20, and 20 is about the same as the S&P 500, 19.75. The Dow Jones is more, it's 22.6. The dividend yield is not bad. It's healthy. I'd like to see more. I'd like to see 3%. This is 2.85%, but it's you got to realize that that price is awfully high. So you will get an annual dividend of about $20 through four quarterly payments. The earnings per share is 35, so it's more than sufficient to cover the $20 dividend. The market cap is $105 billion. Okay, let's move on. So price return is pretty good over the long time horizon. And I'm looking at Max. I look at all of them, but I looked at Max. It's a little under 4,900%. And that goes back to 1999. That's pretty decent. Let's keep going. Total return, well, it's another 3,000%. You're basically at about 7,800%. So remember, total return is price return or price appreciation plus dividends. That's the dividends. It's getting you that extra 3,000%. And if there's a lesson to be learned here, it's basically whenever you can, drip, reinvest those dividends back into your holdings, reinvest, grow your holdings. It makes all the difference in the world. So they get very high dividend scores. You can see that the yield is modest, and it's really compared to their peers in the financial sector. So the safety score is A plus, the the growth score is A plus, the yield is D plus. The consistency score is A minus. So okay, so the dividend yield is a D plus because it's only 2.85%. The forward yield is a little bit less, and you're going to see this on another slide. It's probably a 1% or so less than the median of its peers in the financial sector. However, safety score, meaning the payout ratio is less than 60%. So that's a safe dividend, as well as the consistency. It's an A minus because they've been growing it for 13 consecutive years. Now, that's something to be said. They're more than halfway to becoming a dividend aristocrat. Uh, Now, I'd say the cherry on top of the sundae is the 5 year CAGR. Okay. Dividend growth is an A minus, and it's 12.93%. And I'd say it's at least an A minus, but in my mind, it's an A or an A plus. And what I really like is looking at that growth rate and that yield together, that's almost 16%, the 12.93 and the 2.85. And I like to see both of them together at least meet or exceed 10%. Well, this exceeds that beautifully. Beautifully. All right, let's move on. Again, the yield is modest, 2.85%. Look at the sector median, it's 3.85% right there. But they do make up for it with the dividend growth rate. And here we are. Look at those green grades, the 3 year CAGR, the 5 year CAGR, and the 10-year CAGR. And in most cases, you're looking at CAGRs more than 12, 12 and a half, almost 13%, whereas the sector median are in the mid sixes, mid sevens, low eights. So really, really just great dividend growth by BlackRock. Who are its peers and competitors? Well, okay, you can see BlackRock, and let me just draw your attention to the market cap. It's 105 billion. They have 19,500 employees. The peers are Blackstone, Brookfield, KKR and Company, Bank of New York, Mellon Corporation, and Ameriprise Financial. And I get these from Seeking Alpha, and I could have added more, but you got to just pick the right number. And I looked at these are good comparisons. I will say something about Blackstone. Their market cap is about $1 billion more, but everybody else's is much, much smaller. The CEO of BlackRock actually used to work at Blackstone many, many, many years ago, and then he left and went to BlackRock. All right, a little bit of an info nugget for you. What you see right here is that the price is significantly higher for BlackRock. It's 702 for BlackRock. For Blackstone, it's 91. For Brookfield, it's 33. KKR, 57. Bank of New York Mellon, 44.65. They're all under 100, so they're very cheap compared to BlackRock. The only one that's over 100 is Ameriprise. They're at 325. All right. So let's take a look at total return that BlackRock has compared to their peers. And as I mentioned, BlackRock's is almost 7,800% over the max time horizon, going back to 1999. And, I really think that you need to look at, I like to look at the different um, time frames along a graduated schedule. But when I look at this graph, I look at the maximum time horizon. And what I see here is that Brookfield actually has a better total return. They're 8,800%. Take a look at that. Wasn't always like that. I mean, if you go back right before 2020, they were about the same, but they've always kind of been hovering above them since maybe 2010. And you know what's interesting? Everybody else is way, 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 way below, not even close. I mean, Blackstone about 668%, KKR 321, uh, Bank of New York 37, Ameriprise about 1290%, but they're way, way, way below. It's BlackRock and it's Brookfield. Um, so something to think about. I did mention the graduated schedule here, and you can actually see the total return from 1 month to 10 years. These are really what I would call point in time returns. And I would say that basically, in the short time horizon for the last 9 months, it's really KKR. And then in the longer time horizon, 5 and 10 years, it's Blackstone, essentially. But those are point in time returns. So, how does BlackRock stack up ratings wise against its peers? Well, you know what's interesting, and the more I look at these, Wall Street is a buy, always a buy or a strong buy. They're very bullish on lots of things. Here, no difference. And then, of course, analysts from Seeking Alpha or the contributors, they're buys on all of them. So where do these firms separate themselves? Well, with the quant ratings. And right now, it's Blackstone and it's Ameriprise, and then the rest are considered holds. So Blackstone and Ameriprise are buys, and the rest are holds. So dividends, and I did allude to this. I would say that as a dividend investment, it's BlackRock. Uh, I would say that dollarized, you're going to get more um, from BlackRock, but you're going to pay more. It's going to cost you more to buy a share, but you'll get $20. The Kagers by far are BlackRock. Um, I want to mention, I want to give them their props, but I also want to mention Bank of New York and Ameriprise that consecutive years of dividend growth are impressive with all three of them. BlackRock has been increasing their dividend for 13 consecutive years. Bank of New York Mellon 12 years, and Ameriprise 15. I'm sorry, 16 years. So they're all really good at increasing the dividend. But I got to say this, the CAGR for BlackRock is better. It's better than Bank of New York and Ameriprise. And you can see you're looking at 12.55% at the 3-year CAGR and 12.93% at the 5-year CAGR. They're just better on those. Now, Blackstone's CAGRs are really good, but they've only been increasing their dividends for 2 years. But look at their 3-year CAGR; it's 25.6%. The 5-year is 12.3 for 34%. That's pretty good. So and I've mentioned this before. When you look at these metrics, you're never going to be able to say, "Aha, BlackRock wins on this metric, so I'm going to invest in BlackRock." It's never that simple. It's always more complicated. You got to do some digging, you got to do some analysis, and ultimately, you're going to have to make an assessment of where you want to put your investment dollar. That's really how it works. All right, let's move on. Dividend grades. Well, you know what? It's to me, it's BlackRock. 3 of their 4 grades are in the A minus, A plus range. They get the 1D plus for dividend yield. Blackstone is mostly B's and B minuses. Ameriprise gets a couple of A's, but they get a B and a D. So it's kind of mixed. I'd say BlackRock and then Blackstone, but it's really BlackRock. Valuation, it's a little bit more mixed. I like to look at the PE, the forward PE, and the trending 12 months. I'd say with forward PE, it's Brookfield. They have a low one, as does Bank of New York. They're both in the 9 to 10 range. The trending 12 months, it's Bank of New York, and it's Ameriprise, and then it's BlackRock. You know, a 21 PE ratio for trending 12 months is good. It's very good compared to the market. The others are really low. So those are cheaper investments. So then you got to ask yourself, so why are they so much cheaper? And you have to look at more of the metrics. It's not always the price, but it's the value. So something to think about. And I think that these are also pretty good investments. But I got to tell you, I do like the dividend. Okay, let's move on. So growth, well, growth, I would say that around net income, it's going to be Blackstone and it's going to be BlackRock, and then the others are just not good. And I'm looking at the 3-year CAGR. The tangible book value for the 3-year CAGR is by far and away it's BlackRock, and then of course the levered free cash flow for 3-year CAGR is BlackRock. You can take a look at these, take a closer look. Revenue growth, it's really not necessarily BlackRock. It's really more Brookfield and KKR. So again, it's kind of mixed. You got to dig a little deeper, and make an assessment. Here with profitability, it's BlackRock. The net income margin, the levered free cash flow margin are BlackRock. Uh, you know, you know what? Look at the net income per employee. By far, it's BlackRock, 251,000. Nobody's even close. Ameriprise is 159,000. KKR's is negative. Brookfield is barely breaking even. Blackstone's about 131,000. So it's BlackRock here for profitability. Price performance. Well, I'm going to tell you, it's not BlackRock. It is, and they've been fine they've been positive. Okay. 1 month, 10 months, I'm sorry, 1 month, 3 months, 6 months, 9 months. They've been in that 10 to 12% range. But I see a little bit better performance with KKR. Longer term horizon, it's Blackstone. And I'm looking at 5 and 10 years. Now, if you even go beyond 10 years, well, we saw that Brookfield was, a little bit better. But you need to go and you need to dig a little. And you need to figure out what is the most important metric for you that's going to tip one over the edge. I would say, risk. I'm looking at the betas, and the betas are over one. They're more. There's more price volatility here for BlackRock than the S&P 500. There is more for all of them except Bank of New York, which is less. Um, but you know what? Sometimes that volatility is positive and it's good. So you just have to decide, are you willing to deal with price volatility? Um, I am. I like a little volatility as long as I can balance out my portfolio a little bit. Let's look at some of the income statement measures. Well, I would say that I am really impressed with the net income for BlackRock. That's to me probably the most important measure on this table. Brookfield has more revenue than anybody, but as far as net income, they're less than a quarter of BlackRock's. So I'd want to know why. What happened? That to me is important. But you can take a closer look at these. Balance sheet. I like the fact that BlackRock's debt is low. It is really lower than what I see here with Blackstone and Brookfield by far. And I like their debt to free cash flow ratio. It is 19. It's lower than anybody's. And I like that long term debt to total capital. It's less than 18%. So that tells me that they don't have a lot of debt. It's not bad, it's manageable. Cash flow is good. Their net cash flow from operations, little under 5 billion. Bank of New York has almost 13.5 billion. Um, you know, they all have pretty good cash flow except KKR. Um, so if I see a negative cash flow, I pretty much rule out an investment. I would say that they all have decent cash flow. So, what are the key takeaways here? Um, Blackstone by far is the largest money manager in the world. They control over 10 trillion in assets. However, and I didn't put this here, but from what we saw from the 13F, there's about 3.4 trillion. So my question is, where's the rest? Is it in cash? I don't know. I'd like to know. They invest in everything. They're very well diversified. They invest in all levels of size and shape and dimension of investments. They have offices all around the world. They were founded in 1988. They're very politically connected, and they have strong ties to the Democrat Party and the Federal Reserve. Their top five holdings are Apple, Microsoft, Amazon, Nvidia, and Google. And it exceeds oh those five holdings are over $500 billion, over $500 billion. Just those top five. The PE ratio approximates the S&P 500, but it's less than the Dow Jones Industrial Averages PE ratio. They closed last Friday, June 16th, at $702. Their dividends are better. They're better than their peers. Their forward yield is a little bit modest compared to their peers, but the 5-year CAGR is superior. They got a dividend growth streak of 13 years. Okay, I mentioned the yield. They got a market cap of 105 billion. Only Blackstone's is a little bit bigger at 106. Everybody else's is much, much smaller. They've had an impressive price return of 4,900% and a total return of 7,800% since 1999. Only Brookfield has had a better total return over the max time horizon, and they go back to 1993. Or at least that's the information that we have here from Seeking Alpha. Bank of New York Mellon and Ameriprise have better, more favorable PE ratios. Brookfield and KKR have better revenue growth metrics. BlackRock has a better net income and profitability metrics. Blackstone, KKR, and Ameriprise have better price performance. BlackRock has the most favorable debt levels. So, what is my assessment? I think that BlackRock is a fine investment. Am I going to go out and buy it right now? Probably not. I think it's a little too pricey for me. Some of my other holdings, like I have in Broadcom, and in Costco and in Lockheed Martin, are pricey. You're talking about companies above $500 and $600 a share, and I have several shares of those. And I don't know if I want to go into another one at that level, but I'm watching it. I think it's a good investment. They are politically connected, so it's something you got to think about. Not saying it's good or bad; it just is what it is. But that's my story, folks. So I will ask you to kindly give us a like if you would, and subscribe to our channel here at Dividend Blasters, and share the video with a friend or a family member. And really, thank you for sticking with us through this journey. This has been our 42nd video, and I am grateful. And I hope you found this to be informative and entertaining. Until our next video, have a great day and God bless.